Good morning, or kia ora, as we say here in New Zealand, where I'm currently escaping the UK winter. Thanks for joining me for today's FS Club update on EU financial services legislation and associated initiatives. It has become tradition at the FS Club for Dr. David Doyle to provide us with his hotly anticipated update on the EU financial services regulatory agenda in January. So today we'll be looking at the EU Artificial Intelligence Act, the new EU AML Authority, Crypto Assets Regulation, and the Digital Operational Resilience Act. David has dialed in from France this morning, so we are very international with his club today. David is known across Europe as a leading expert on EU financial services regulation. A former diplomat with over 20 years' experience in mainland Europe, he now acts as an EU policy advisor, is a board member and secretary to the Financial Services Working Party of the Joint MEP EU Industry Advocacy Body at the European Parliament, and he holds a seat on the board of directors at the Genesis Initiative at Westminster that promotes entrepreneurship and SME policy. Now, before I hand over to David, the usual brief housekeeping points from me. If we haven't met yet virtually or in person, I'm Charlotte Dilber-Ashley and I manage the FS Club here at ZN. I'd like to warmly acknowledge our very generous sponsors who enable us to continue to bring you a wide range of thought-provoking content across finance, technology and economics. As usual, we've got the slides publicly available on our website and the chat box. We'll record the session and it will be available to watch on our website within 48 hours. And we also have a 20-minute Q&A session after David's presentation. So please use the chat facility to send your questions into me early and then I can feed them into David. Now, without further ado, it's my pleasure to hand over to you, David.
Thank you, Charlotte, and welcome everybody to this opening session of the Financial Services Club on the theme of developments in the EU financial services regulatory agenda. Well, as we open the new year, hawkish remarks from the European Central Bank and indeed from the Federal Reserve in the US emerged last week as to the notion of whether interest rates will be lowered over the next couple of months. And the expectations were distinctly dampening in terms of any expectations of lower interest rates over 2024. No change in interest rates in April, says ECB President Lagarde, but maybe this summer. Over the last 2 years, of course, economic developments in the EU have been considerably influenced by a combination of easing of pandemic-related supply constraints and higher energy costs as a result of the Ukraine-Russian conflict. But since last year, low inflation and accommodating monetary policy in Europe have given way to unprecedented hikes in inflation, prompting the European Central Bank to tighten monetary policy with 9 consecutive hikes in interest rates, reaching a total of 450 basis points by September of last year. This, of course, makes debt more expensive, and it also invokes the question by many investors as to what banks can offer in terms of products when the clients can find equally attractive and compelling interest rates and yields elsewhere. So as we enter 2024, and despite much progress made in curbing inflation, central bankers both in the US and the EU say that more needs to be done to ensure a timely and sustainable return to the inflation rate of 2%. Another major challenge, of course, facing Europe is continuing weak economic statistics. The outlook is rather pessimistic. Only last week, it was reported that the German economy had contracted by 0.3% over 2023, making the EU's largest economy the weakest performer. 2024 will also mark the year of pivotal elections in some 12 EU and indeed European countries, including the June European parliamentary elections, with resurgent populism featuring highly in all of the cases. A sizable increase is expected of MEPs from the populist right political parties going forward this June. And tomorrow, the European Commission is set to unveil its economic security package, led by a focus on injecting national security concerns into economic decisions. This will be led by notions of protecting and promoting indigenous EU-led technology and industry, and screening critical outbound investments from EU companies and indeed countries into third countries. Meanwhile, the largest political party in the European Parliament, the centre-right European People's Party, has begun campaigning ahead of the elections in June, urging cutting down of the EU bureaucracy and red tape, in particularly key areas like actually artificial intelligence, noting that we should be looking at legislation that enables, develops, and utilizes AI, not contain nor hinder it, end of quote. It also echoes mounting complaints from across the EU about overregulation in environmental, agricultural, and social policy. But actually, none of these initiatives seem to have stemmed the appetite for new legislation over the past year in the financial services space. With MEPs on the Belgian-led EU Presidency Council dashing to ratify some important pieces of legislation before the June parliamentary elections, the most prominent of these will be, in my view, the EU Artificial Intelligence Act, the Crypto Assets Regulation, DORA, amongst other issues, and of course the EU anti-money laundering strategy. Next slide, please. So moving into the EU Artificial Intelligence Act, it's a distinctly European approach. In fact, all of these pieces of legislation have distinctly European character of extraterritoriality, comprehensiveness, and also huge scope in terms of the key financial actors. Now, if we look at the McKinsey report that was published late last year about the benefits and virtues of AI, saying that it would lift productivity of banks by 3 to 5%, reduce operating expenditures by up to $300 billion by simply automating 25% of all the work done by banks. And not to mention the generative AI systems, which according to the PwC policy report, again late last year, suggested that this could boost profitability, according to 46% of PwC interviewed chief financial officers across the globe. But the piece of legislation we're looking at, which is due to be introduced very, very soon, in fact, enforced by 2026, it's at the last legs in terms of its ratification. Its overall objective is to increase the acceptance and trust of AI, particularly vis-a-vis European consumers. The focus, again, of all this legislation, crypto assets and DORA, is to ensure that individual citizens across Europe are protected. It has opted for a distinctly horizontal approach. In other words, there isn't going to be a sectoral approach for financial services, energy, telecommunications, but there are some very clear indications about the financial services implications of this piece of legislation. For a start, the system, the AI approach or orthodoxy, doesn't set out to actually ban any AI models per se, although there are a couple that will probably find themselves being banned, but more about, again, identifying the risks of each AI model in terms of this pyramid structure of classification of risks. If we could please move to the next slide, where you will see that the classification system begins at the very top of the pyramid, unacceptable risks, which will mean prohibited activities. But the bulk of activities, at least in the financial services sector, will fall within the high risk area, which will mean conformity with a number of measurements, a number of reporting and compliance arrangements, which will have to be approved and licensed by the European Commission, but obviously delegated to the national competent authorities. And within this particular area, high-risk areas, we see questions like the use of real-time remote identification, biometric identification in terms of usage of certain characteristics, whether they be political, race, religion, sexual orientation, all of which feeds into three distinct areas where the AI Act will not again ban such AI models, but will certainly ask for justifications from financial institutions before they can be fully implemented. And they include, amongst other issues, credit rating systems, automated insurance claims processing, and setting risk premiums for customers in the insurance space. Probably these single one or two, maybe three important takeaways from this piece of legislation. One, its comprehensiveness. It covers all creators, providers, deployers, importers, distributors, and product manufacturers, but not users. And this is extended also to all actors who develop, import, distribute, and manufacture IA models, whether they be indigenous to Europe or whether they be third country. And indeed, the extraterritorial dimension here provides for ensuring that any provider of AI systems located outside of the European Union, must ensure that they are fully licensed and that they also have a physical presence, legal presence in one of the EU member states. Probably the other most important feature of this piece of legislation, and one that has caused quite a bit of concern and is indeed still very contentious, is that the ultimate responsibility and indeed liability for the misusage of AI by any financial institution as it develops through the food chain, through brokers and dealers and intermediaries, all the way to the users, the responsibility for misusage down the food chain will remain with the original AI creator. Thus, the licensed firm using the AI model not at fault. So clearly, this is something we need to be conscious of, take the necessary precautions. There will be a licensing, there will be a pre-screening, particularly in this high-risk category, less so for limited risk, and also for minimum risks. But again, the financial services sector really clearly falls within this high-risk area, which doesn't mean it's going to fail to achieve authorization, but two factors. One, clear screening and proof that, particularly in relation to generative AI, that there is disclosure of the content that is generated by the AI. Secondly, the models must be designed to prevent it from generating illegal content. And thirdly, there must be a disclosure, a publishing of summaries of the copyrighted data used for training purposes. A lot of this will be in the public domain, so it won't be just the regulators, it will also be NGOs and pressure groups will be looking at these issues very carefully going forward. Next slide, please. The new anti-money laundering strategy. Only last week, the final dimensions of the EU AML strategy were actually approved by the Council and the European Parliament. I'm speaking about the 6th Anti-Money Laundering Directive and a new regulation on a single rule book in relation to AML provisions. All of these issues will feed into the compliance function of a new, brand new, game-changing, independent EU Anti-Money Laundering Authority. We don't know where it's going to be based yet, but it will be set up operational by 2026. Its main purpose will be to oversee directly, a bit like the ECB does with systemically important banks, But this new EU AML agency will directly supervise some 40 plus most high-risk financial entities at group-wide consolidated level across the European Union. And this also includes third country financial institutions, particularly also institutions in Europe that have either are part of a larger group with headquarters, subsidiaries or branches outside of the EU. And secondly, financial institutions that are operating perhaps in very few small, in a very small scale in a few EU member states, but have a very high ratio of value of transactions with third country institutions, clients, intermediaries, etc. It also will have oversight of the national AML supervisors in the financial sector. It will pretty much set the rules there. What I foresee is a diminished role by NCAs at national level and also the European Banking Authority. Who are going to be involved? Well, clearly, again, comprehensiveness and extraterritoriality characterize much of this particular initiative. You can see from the list on the right-hand side of this screen, it will include obviously banks. It will look at major financial institutions in the area of investment firms, payment service providers, life insurance, undertakings and providers, crypto asset providers, and crowdfunding platforms. A huge comprehensive scope. And interestingly, over the next couple of months, in fact, it's already underway, the three ACERs, the three EBA, ESMA, and EIOPA will be working on, in tandem with this new authority, on looking at benchmarks for the purpose of defining risk factors that will be used by this new authority to determine whether financial institutions are systemically important in terms of risks in relation to money laundering. And the criteria that they're going to be using will be customer. We all know that, for instance, certain customer categories are more vulnerable, such as non-residents. Products, crypto assets can be very vulnerable to money laundering vulnerabilities. Services like investment advisors, transactions of certain nature, delivery channels, and geographical areas. Now, for geographical areas, quite obviously, they will start with the OECD Council blacklist and grey list of countries that have been listed as being non-cooperative jurisdictions. Already late last year, there were a number of new jurisdictions from Africa and the Middle East who were added to the list. So they will clearly be areas that will be focused on in terms of defining the specific risk factors associated with each of these 40 plus financial institutions. But over and above that, clearly the choice of who will fall within the direct supervisory remit will also depend on defining high-risk cross-border banking and financial institutions with activities in a significant number of member states across the European Union, not necessarily, by the way, with links to third countries. And in exceptional cases, any entity, whether it be a bank, whether it be an insurance company, a fund manager, that has had systematic and repeated breaches of applicable requirements in relation to the 5 anti-money laundering directives. And there are quite a number of those, as we know. At the end of the day, we will end up with at least one financial institution in each of the each member state, at the very least, sometimes even two. But quite visibly, this is going to be a game changer. And January 2026 is the date when this new authority will begin operations. We don't know where it's going to be based. That's the only remaining issue. But quite visibly, we are moving towards 2026. And this will indeed include a mandate to negotiate with third country regulators and governments and AML authorities in terms of exchange of information going forward. Next slide, please. The third area that is hugely in the field of game-changing legislation, and again very comprehensive and with some extraterritorial scope, of course, is the markets in crypto assets regulation, which will be coming into place very, very soon. Now, it's a regulatory framework which is, again, very comprehensive. In other words, any person, any firm, any entity, financial or non-financial, that is engaged in the issuance, public offering, admission of trading of crypto assets, or servicing of crypto assets that cover both issuers in terms of unbacked crypto assets and stable coins, and service providers, the so-called CASP, which includes exchanges, trading platforms, custodian wallet providers, to mention but a few. So a very broad definition, which is not what we find in crypto asset legislation in the United States, the UK, Switzerland, or elsewhere. It will impose a liability on crypto asset service providers for custody losses, in other words, due to cyber attacks on digital wallets. It will have some very robust anti-money laundering provisions, which were introduced in extremis, which will ensure or will require any service provider involved in transferring sources of crypto assets to check out and carry out due diligence of both the sources and the beneficiaries of funds in excess of crypto assets worth €1,000 or more, particularly for unhosted wallets. And the other interesting feature is, of course, this piece of legislation has no equivalency or mutual recognition provision. In other words, for non-EU crypto asset actors from outside the EU, you need to have an EU presence, either in the form of an e-money firm or a bank or some other legal entity in the EU to be able to participate actively across the European Union. The major challenges are, of course, the hefty capital requirements in the case of asset reference tokens, for instance. Own funds need to account for at least 2% of average outstanding e-money tokens, and also €350,000 of initial capital, whereas the crypto asset service providers need to have minimum capital of anything between 50 to 150,000 euros, depending on the class in which they are offering the services. For instance, for trading platforms of crypto assets, they will need to have a minimum capital requirement of 150,000 euros. But it doesn't end there. There are also issues of disclosure, reporting to the national regulators, conflict of interest requirements, redemption rights, complaints handling mechanism, and orderly winding down plans as well. The crypto asset providers are probably the most heavily regulated, that they need a license, which can only be provided by the national competent authority in the country where they have originated, particularly if they're providing custody services, brokerage, trading, or advice. Now, it doesn't end there. We still have the other elephant in the room, that is the prudential capital requirements. And here, last year, the whole of industry was stunned when the Basel Committee of Banking Supervisors proposed a 1,250% risk weight on cryptocurrencies, both long and short positions. And the issue wasn't taken up by the Commission, and indeed wasn't part of the final bank prudential Basel III regime that was just approved in October of last year. But clearly this issue is not going to go away. The banks will need to prepare themselves for some unfavorable risk weightings, I think, over 2025 or 2026. High entry costs for all crypto asset players, but not just third countries, but small to medium size crypto asset players, both in terms of the cost of prospectuses, capital reserves, reporting, DORA type security arrangements, governance and compliance costs. And the other, of course, remaining issue is we still have a very highly fragmented international crypto asset environment. Okay, the EU is moving in one direction very comprehensively, but the rest of the world has enormous arbitrage risks, as I see it, in the UK, China, the USA, Hong Kong, Nigeria, to mention but a few. That in spite of the fact that the G20 did agree 2 years ago to look into the prospects of at least a overarching piece of legislation. They're still currently working on this. Last issue on the agenda, the Digital Operational Resilience Act, in the next slide. Now, we were reminded just how vulnerable the whole digital space is in financial services in mid-November last year, when the largest Chinese bank with a base in the United States, the Industrial and Commercial Bank of China, was hit with ransomware, which prevented it from settling transactions on the US Treasury market. The hack was eventually contained by disconnecting the systems, but not before the bank, the Chinese bank, had to inject something like $9 billion of capital to build up and boost its capacity. This was indeed a wake-up call to regulators in the United States, but elsewhere as well, for financial corporations, regulators to step up their efforts to deal with cyber security in general. And this comes at a time also that when we probably don't need reminding. For many, many years, the European Central Bank, or the SSM, has been warning about the vulnerability factors lurking, particularly in the banking sector, in relation to digital reliability. Particularly in the last couple of years, banks were seen as purchasing from a small pool of ICT providers, third-party providers, leading to a concentration of risk, the sort of single point of failure. And in the US and the EU, access to third-party cloud usage is on the increase and is expected to increase to about 90% by 2026. 70% or 76% in Europe of financial institutions, notably banks, IC department, are using at least one end of life IT system, 76%, which is a huge damning feature. IT changes internally are seen as being a potential area of triggering digital vulnerabilities. But more vulnerable again is this particular focus of this piece of legislation on third-party ICT providers. And here the ECB, SSM have been very vocal in pointing out that frequently used third-party ICT providers support many of the major financial institutions in terms of notably their critical, important functions. In other words, if any one of these functions were to collapse, it would have huge implications, both in terms of the bank or the institution itself, but also in terms of financial stability. There was also a significant use of subcontractors by third-party ICT providers, adding further complexity to the chain of events. And many of the ICT services supporting many of the big financial institutions were often non-substitutable. In other words, if they were to collapse as a provider, it would be difficult to find very quickly, within 24 hours or 24 days, a substitute that could be brought to the table. Now, add to this the use of artificial intelligence, which has meant crypto criminals have increased the number of hacks. BT, British Telecom last week announced that something like 46 million signals of potential cyber attacks occur every day worldwide, most notably in the banking sector. So why should we be surprised when DORA was presented and has now been, of course, been ratified and applicable from the 16th of January 2025? One, it will incorporate critical third-party ICT providers in the regulatory oversight scope, including cloud service providers. They are now becoming a bit like systemically important banks that are too big to fail. The ICT providers of a certain size and magnitude and influence have become systemically important in their own right. So for all financial institutions, banks, insurers, well-documented ICT risk management frameworks with adequate, well-articulated policies, procedures, and protocols, reporting major instances to the national regulators of ICT failures or cyber threats, and perhaps more importantly, introducing a digital operation resilience testing once a year or perhaps every 2 years to assess the preparedness of how the internal ICT related department is functioning in relation to these instances, identify weaknesses, deficiencies, gaps, and it goes further in terms of the ICT third-party providers who themselves will be subject to a yearly, perhaps a twice yearly ICT third-party risk assessment or test, which will ask the financial institution to do some pre-outsourcing due diligence, assessment of the ICT third parties' concentration risks, the disaster recovery, if it exists at all, at third party level, governance arrangements, reporting major ICT instances. All of this will need to be assessed by the banks, insurers, fund managers, vis-a-vis each of their ICT third-party providers. So a huge amount of work still needs to be done. 16th of January 2025 is when all of this will apply, and it will equally apply to third-party financial institutions and, importantly, to third-country third-party ICT providers. And indeed, one of the extraordinary elements in this piece of legislation is that, in effect, third-country ICT providers based outside of the European Union will need to have some form of legal entity in one of the 27 EU member states in order to continue to provide services to major financial institutions that operate anywhere across the 27 EU member states. And on that note, let me hand the floor back to Charlotte. Thank you.
Thank you very much for that in-depth presentation, David. Do keep sending your questions in via the chat box there. Firstly, what insights do you have into expectations for the UK-EU relationship in terms of access to the single market?
Yeah, I remain, or I've become perhaps cautiously optimistic, which wasn't the case this time last year. A couple of reasons for this. One, the memorandum of understanding between the United Kingdom and the EU in relation to a task force that would be formed to ensure a dialogue takes place at least once a year between the regulators has now been signed, and there's work continuing at a very tangible level to ensure adequate, timely exchange of information. So that's the first point. Secondly, I think there is a sense of, at least at Brussels level, that given the important footprint of the City of London vis-a-vis the EU in terms of raising funding, in terms of derivatives trading and clearing, in terms of a range of FX trades, which still remain very, very sizable. There has been, I think, an explicit recognition that there needs to be an extension to the temporary equivalency arrangement, at least vis-a-vis derivatives clearing, beyond mid-2025. And this could extend to other areas as well. Clearly, I remain optimistic once we've got through the first couple of exchanges of information to look at ways of reducing arbitrage that will inevitably occur should the two regions diverge without any discussion or exchange of information.
Do you see, with the election, the UK election coming up this year, do you think a change in government resulting from that will have any impact?
It depends who gets elected, clearly. But there have been, certainly the opposition party has been making a number of positive soundings that there needs to be perhaps scaling up of dialogue with the EU partners. And this, of course, has been greatly facilitated by an alignment of views and orthodoxy vis-a-vis the conflict between Ukraine and Russia, where clearly there needs to be more dialogue at this level. There's also been a lot, I think, a constructive dialogue about in other areas not relating to financial services, which give hope, I think, to further down the road to perhaps a more active, constructive dialogue about equivalency arrangements that go beyond purely derivatives clearing, but issues like establishing branches, for instance, of third country banks in Europe, which have now been incorporated into the very recent Basel III CRD6, CRR3 regime, I think provides at least some clarity in terms of what needs to be done and how this can be made operationally resilient for third country banks in particular, as they seek to continue to provide services to retail and professional clients in the 27 new member states.
I think when we get you back for an update sort of mid-year, June or July, it will be good to revisit this topic. Dr. Doyle has also kindly offered to answer any more in-depth questions we won't have time for now, so you can email him separately. We've got his email there in the chat, or contact him after this and he'll get in touch with you at his convenience. So thank you very much for that, David. So we're about coming to the end now. So thank you very much for joining us this morning. And thank you again, David, for coming on and giving a very insightful presentation. And also thanks to our sponsors for making these webinars possible, and to our audience, of course, for logging in today. And don't forget to check out the For Current Events page on our website. We've got lots more coming up over the year, including in-person events, and the Lord Mayor's Knowledge Series webinar program will continue, as well as the regular FS Club webinars. Thank you very much. Thank you, David.
Thank you.
Bye.